Welcome to Bullshift the podcast, the weekly podcast where we talk about personal finance from a perspective of behavioral economics with a particular focus on optimism bias and how people are shifting their attention to be more optimistic. Before we get into today's episode, I want to ask everyone watching today to like and subscribe. It's really important for the algorithms. You've been following me this long, so thank you for your support. I hope you have more content coming your way, and we'll look forward to talking to you soon. My guest this week is Daniel Straus, and I've got a lot to read about Dan because he's quite the guy. Daniel heads the National Bank's award-winning ETF Research and Strategy Group, and that focuses on providing both institutional and retail investors with value-added, actionable investment advice on exchange-traded funds. The group regularly publishes street-leading reports on the ETF landscape in Canada and the US, including themes and flow reports, model portfolios, trade ideas, and the like. Daniel has appeared on a number of media outlets, including BNN, National Post, Bloomberg TV, Les Affaires. He became the managing director of ETFs over at National Bank in 2023. He holds a bachelor's degree in applied science and engineering from the University of Toronto, a PhD in engineering from Brown University in Providence, Rhode Island, and a master in finance degree from the Schulich School of Business. His team was recently named the best ETF research provider in Canada, and he says that reflects the cross-disciplinary collaborative environment that he and his people work with in National Bank and their capital markets. Daniel, welcome to the program.
Thank you so much, John. It's great to be here.
I wanted to begin by, I cannot help but note that different people have different bios when they come to appear on this podcast. And yours straddles. You have a background in engineering and you have a background in money and in finance. And I'm wondering if you could perhaps share with us the journey that you've been on that has led you to what you're doing today.
Sure. Thank you, John. So I may have talked about it before. So let's see if I can give an accelerated version. I've always been very curious and I've always loved science. And I thought to myself that I would devote my career to that. And I studied engineering science at the University of Toronto. I got a PhD in engineering where I studied opto nanotechnology at Brown University. But I always had a hobby interest in finance. And I guess you could say it was an accident of history. The financial crisis occurred just as I was graduating. And there, my intellectual curiosity kind of took on a new dimension as I came to understand the forces that I guess really shape our world. And I could say then that as I was reading about it, the thing that made me most interested to enter a master finance program and study it formally was the fact that, unlike science, which actually has answers, there is an objective truth. I would like to think you could talk to philosophers about that, but there is an objective truth that kind of underlies our world of physics and chemistry and so on, mathematics especially. Within finance, it's a crowd behavior. And the more we as practitioners understand it, the more the system incorporates that knowledge into its own behavior and pivots around it. So it's like a slippery bar of soap that you're trying to hold on to and it's constantly eluding your grasp. I think that takes a kind of humility. It means the kind of intellectual pathway to continue to explore and discover things is never ending.
You got me thinking about game theory because game theory is how different people and people who have read Bullshift the book and who are familiar with maybe the movie A Beautiful Mind. John Nash won a Nobel Prize for his work with regard to game theory and how different people react and adjust their strategy, not based on exogenous factors, but rather based on what other people are doing. And as you play the game of how to invest or how to do things, you think about things. And as a result, what you're telling me is, I think, is maybe you've come to realize that people in finance have physics envy, which is to say they like to have a lot of people who work in different careers like objective truth. But in the field of finance, there are things that are more true than most, but not unequivocally, unambiguously, categorically true, just tend to be true. I wonder if you could maybe expand on that thought.
Yeah, no, physics envy is 100% a real thing, not only within finance, but many, many other domains. Even physics to a certain degree. One of the jokes we often told in physics is, when you're trying to model a system, for instance, it's convenient to assume that all the components of the system are as simple as possible so that you can model their interactions. And so you would imagine, for instance, that everything is a perfectly frictionless sphere. Right. The thing is that in astrophysics, people would talk about complex systems like a cow, or I mean, not in astrophysics, but biology. Assume a spherical cow. A spherical cow now is something of a meme in the world of science and physics. That when you simplify a complex system to understand it, to grasp it intellectually, you might be oversimplifying. And I think it's almost certainly true that in domains like finance and economics, we assume that humans and their behavior are like perfect frictionless spheres. But I think that in practice, there's a wealth of evidence, especially in the field of behavioral finance and its second wave and third wave, that shows that human beings and even all the subcomponents of economic markets are anything but frictionless spheres.
People respond to inputs, factor inputs, and they make their decisions based on things that are available to them. So there are things like availability bias and recency bias, and we don't like to admit it. One of the things that's funny, and it's certainly true with the people who I speak to that work in the finance sphere, they try to make it as empirical as possible, and they say implicitly, well, because I've crunched these numbers, I have a better understanding. And I would respectfully say, you don't understand it, because if you think it's about the numbers, that just shows that you don't understand it, because most of the problems in finance are dealing with these interactions, right? And the way different people think about it. I'm wondering if you could perhaps tell me your views on the interplay between traditional economics, which is the numbers, and supply and demand, and the things that we think of with regard to Keynes and whatnot, and then the upstarts, the challenges, the updates that are being given to us all the time with regard to what we learn about nudges, and what we learn about prospect theory, and what we learn about how we make decisions imperfectly because we're human.
Right, right. No, that's a really great question. I would say, for instance, perhaps my favorite example of physics envy, and maybe something that touches upon the kind of list of behavioral science findings that you talked about there, is the Black-Scholes equation for option pricing. It's something that's almost carved in stone in the world of quantitative finance, right? This is it's a simple equation, perhaps not so simple if you're studying it in your a business school, but it's an equation that governs the prices of put and call options under certain simplifying assumptions. And it's in fact the same equation as the heat equation, which describes the flow of heat in a one-dimensional system, which has been known to thermodynamicists since the 1800s. Fisher Black and Myron Scholes won the Nobel Prize for the Black-Scholes equation, governing option prices. All they did was take this well understood 100-year-old partial differential equation and apply it to a simplified system involving stock prices. Now, I'm not saying that this isn't an amazing finding. It's extremely instructive when you study it. You can understand the moving parts of the system and learn how, in fact, even today, options traders use terms like implied volatility to describe the valuation of an option price. But I thought it was fascinating that a 100-year-old physics equation could win the highest award in the Nobel. It's not really it's the Memorial Nobel Award for economics, right? But today, I think our options traders even understand that the Black-Scholes equation, as sacrosanct as it is, has been updated with models upon models upon models. And even if you go into a Bloomberg terminal and you're now asking to price options, for instance, which is something our options desk at National Bank does all the time, there are a wealth of mathematical models to consider. It requires an understanding to know what the variables mean.
Myron Scholes, by the way, is a Canadian. I think you know that, but I don't know how many people listening will know that. But we do have a Canadian Nobel laureate with regard to finance. Can you perhaps give us an example or two about how maybe the work that you do can be applied using behavioral economics? Because a lot of what you do is mostly, and I don't want to presume, and you can correct me if I'm wrong, but mostly quantitative. You're looking at flows. Where's the money going? Where's it coming from? Why is it going here? To what extent can a person like you incorporate things that you're obviously well aware of with regard to behavioral economics into your day job?
Yeah, absolutely. So one of our catchwords, I think, is know what you're buying. right? This was the I mean, buyer beware was in fact the caveat emptor was one of the Latin mottos in the agora in the Roman marketplace, right? Buyer beware, placing the onus on the buyer of something. If they get scammed, for instance, or if they buy something regretfully, it's actually the buyer's fault, right? This was the kind of law of the street at the time. We don't want to be so brutal in our understanding. I think, especially when it comes to the financial marketplace, it's very difficult. If we said buyer beware, I think a lot of unfair practices would flourish. But I think our catchword is know what you're buying, and that's where our research comes in. There are 1,300 ETFs in Canada. There's upwards of 3,000 in the United States, thousands more globally, 7 trillion in AUM in the US, 350 billion Canadian in Canada. The wealth of options is just astronomical. And the problem is that many ETFs are extremely similar to one another. It's a little bit of one of the dirty secrets of ETF analysis that if an ETF tracks the same index, even if it's from different providers, there may only be hairline differences between them. And that's what our research aims to understand. We try to take all the ETFs in Canada and tabulate the differences between them so that clients who have particular goals of their own can make empowered decisions with the understanding of what the differences between the ETFs are. It's not to say that all ETFs are similar. In fact, sometimes very similar sounding ETFs can have astronomical differences between them. Sometimes two ETFs will have very similar names, but one will have a covered call overlay. One will have leverage and other won't. One will be currency hedged and the other isn't. So it doesn't take, quantitative science or astrophysics or rocket science really to understand these differences. But our role as ETF analysts is to kind of survey the entire landscape, crunch the numbers, gather all the data that is possible to be gathered on all these products so that when we work with advisors and institutional clients and retail investors, we can help them in their decision-making process.
Great. I wonder if you could also talk a little bit more about optimism bias in particular, because the book and the podcast talk about optimism bias, and bull shift is really the risk associated with being overly bullish. Do you have things that you can maybe share with the people that are listening about how they might be unwittingly taking on risk because of maybe not being aware of the methodological differences or the things under the hood that you talked about a moment ago? Well, what can you say there?
Yeah, wow. Well, thank you, John. I have to say that the message of your book kind of arrived for me personally just in time. I consider myself a congenital optimist. A lot of people who know me would say I'm a pretty cheerful guy, optimistic, and that can be blinding, right? I don't want to talk about the overall industry practices too much. I mean, you're the expert there, but I can tell you that certainly when I was coming up, for instance, in the 90s and early 2000s. In my engineering program, for instance. The internet was, at the peak of its hype cycle, right? The information superhighway, and I believed it, and I honestly believed that this bridging of the world with information pathways would usher in an age of peace and prosperity. That people would, come across all these different ideological and geographical divides, and we would have a new utopia. I think a lot of people kind of wished for that. Perhaps they were raised on Star Trek more so than utopian science fiction rather than dystopian science fiction. The world we ended up with, I think it's a bit of a rude awakening, especially the past few years. Watching the political cycle, in all sorts of developed economies, even be dominated by misinformation on the internet. Watching the confusion that people had navigating even the pandemic most recently. Forget talking about how to invest through it, even just how to behave, through the lockdowns and vaccinations with your family. Some of the decisions were easy, but some of them weren't, perhaps less so. So I think that that optimism bias is absolutely a real thing, and it's important to perhaps temper it. The flip side risk, of course, is becoming a cynic so deeply that I think that cynics too are rewarded in our society and in our financial markets even, right? There is a certain kind of, I think, bias to assume that those who are cynical and pessimistic all the time are more intelligent, right? There is something of a kind of veneer of intelligence that appears over the person who is perhaps unduly cynical at all times. So I think that the proper line to navigate is one of intellectual honesty and humility without letting either optimism or pessimism blindside you.
It's funny because, for instance, we just had a rate hike in Canada yesterday. And a lot of people have been, people are over the map. We've heard a whole bunch of different stories about how central banks, because it's not just Canada, have a credibility problem. First, they said it was going to be benign, and they said it was going to be transitory, and then when inflation came back and it was bigger, they said, "Oh, we're gonna inflict some pain," and they've been talking about inflicting pain for a year, and yet the economy continues to grow, and we're at full employment and whatnot. And so, a lot of the things that you think about in capital markets are the interplay between what we see in the news cycle and how we interpret it. And a lot of people assume, for instance, that a rate hike will be bad, and therefore the market should drop. And so we had a rate hike yesterday on Wednesday, and markets went up. So you can't always predict. There's no natural causation. The cause and effect that people think would be involved is oftentimes already priced in. And if the market expects a rate hike, then it yawns when it actually happens because it's just what we all expected would happen anyway. Are there other biases that you'd maybe want to talk about above and beyond optimism bias that you think you see that you're mindful of in the ETF space, but perhaps just in finance in general?
Sure, sure. Oh, there's so many. I think that perhaps a recency bias is one that is very well represented in the ETF marketplace. Just talking about this rate hike that we observed, why is it that there's so much, I think, pessimism spread out through the markets, even though there's a lot of good news in terms of employment. A rate hike doesn't seem to be exposing fault lines of fragility throughout our economy, so that might itself be good news. But we observe recency bias in the form of, for instance, performance chasing, one of the kind of a classical kind of biased behaviors, right? There's a whole class of products in Canada, not to say they're bad, called low volatility ETFs, for instance. The low volatility anomaly is fascinating, and it's a powerful factor. There's a wealth of ETFs from providers like BMO and iShares and Invesco that have low volatility ETFs. The interesting phenomenon to observe is that periodically this factor outperforms. Sometimes something upside down happens in the world of finance, and a rule with risk goes reward gets broken, that rule, right? And what we see is that low volatility ETFs outperform, and then in the aftermath of this kind of divergent period of outperformance, they achieve a lot of inflows, which is precisely when you probably shouldn't be loading up on that factor. And then what happens is sometimes the low volatility factor will underperform for a very long time, and then all of those assets will capitulate and flow out slowly, trickle out over time, just as the crisis appears. If you want to use the factor, if you want to have low volatility stocks with low standard deviation or simple metrics like that in your portfolio, so that you can your equity positions can better weather a financial storm, you want to be holding them through a cycle, right?
Cycles,
But
right?
we've definitely met advisors and investors who use them appropriately and are quite judicious with their positions and are and hang on to them for 3 to 5 years, sometimes even longer. They put them as a kind of like satellite positions in low risk investor portfolios, which I think is an appropriate usage. But trying to time it, is the evidence of that abounds, and we see particularly in the run up to the COVID crash or the 2013-14 oil rout in Canada. It was low volatility ETFs in Canada did very well through that 2013-14 period when there was kind of a global trade war in the price of oil. It crashed. Canadian equities kind of took a nosedive, except for the low volatility basket of stocks. Enormous outperformance through that period. These ETFs certainly had their user base throughout that period, but then a whole new investor base came in after that dwarfed the first. We call that performance chasing. We call that recency bias.
It's funny because one of the things that people might be familiar with is that people are always fighting the last war. And you use it in military terms, but you can also use it with regard to the way portfolios are constructed. You think about it, and whatever it was that hit your radar recently, which is a form of recency bias, is the sort of thing that you will then protect against or think about when you're constructing or reconstructing your portfolio going forward for the future. And I think as long as you can stick with it, as you say, you're probably going to be fine. All sorts of strategies work, have their day in the sun, and pretty much all strategies have their time where they don't look so good either. And as long as you don't start flitting between one and the other, you're likely to be fine. All right, so I think we're getting toward the end here. Time flies when you're having fun. And I just wanted to ask you to think about the two things that we talk about at the end of the Bullshift podcast all the time. The first is something that I call shift happens. And if you can think about what goes on in the ETF space and the Canadian financial universe as you understand it, if there was one thing that you could change, Daniel Straus, what would you change?
Wow. I've been listening to your podcast, John. So many great answers from your guests. If I could perhaps draw on one small change from my own personal biography, okay, and that would be education and particular early education around finance. I'm not saying that everybody should learn accounting very early, although I think there's strong arguments to be made for that. But I don't know if there's any physics educators listening. I think the fact that, for instance, calculus is
Mm-hmm.
such a core part of the early education curriculum. I mean, like high school curriculum, is a kind of holdover from the kind of era of the scientific revolution and the influence of people like Isaac Newton and Leibniz, who co-invented calculus. Calculus is beautiful and important, and everyone who's interested in it should absolutely go and study it. There's wonderful videos on YouTube that explain some of its key concepts. But I think that there are other branches of mathematics, like statistics, which I think the greater population is woefully illiterate around key and core statistical concepts. We see statistical illiteracy everywhere amongst policymakers, amongst investors, and I would love it if there was a little more statistics and a little less calculus. Although I love both branches of math in high school education.
It's funny because when I was doing statistics in graduate school, my professor insisted that it was not math. He said, this is not math. This is just understanding probability. It's not actual mathematics. It's just applied logic and looking at large sample sizes and trying to derive what's going to come. You'll notice that I didn't ask you about that's bullshit. And that's deliberate because a lot of people have said in the past that, John, you talk about being optimistic, and then you're inviting people to be critical. And so I'm trying to, and that of course is exactly why I have the shift happens segment as well, because I not only invite people to say, what do you dislike, but then to invite solutions and to think about what might actually happen. You've given us a lot to think about, and I want to thank you for your input. It's been wonderful. Thank you for all the work you do. You really are a shining light in the Canadian ETF space. The world is better for the work that you and your team does because we understand the universe of what the options are. We make better, more informed decisions based on the product universes out there, based on the very good work that you do in finding sometimes nuances and sometimes significant differences in the way products are constructed and the way they might be used in aggregate with one another. So thank you for all you do.
Thank you very much, Sean. It was a very fascinating conversation. I appreciate it.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift: How Optimism Bias Threatens Your Finances. Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.